A car lease. For most of us, it seems pretty straightforward, right? You sign some papers, you get a new set of keys, and you make a monthly payment. But behind that simple agreement, there's a whole different world, a really complex financial engine running with its own rules, its own language, and its own risks. So today, let's pull back that curtain and see what's really going on. It really all starts with this one big question, the one that gets almost everyone thinking about leasing. How is it possible that the monthly payment is so much lower than if you finance the exact same car? Well, the answer isn't some simple trick. It actually reveals the massive difference between how you see the car and how the finance company sees it. So, here's the game plan. We're going to go on a little four-part journey. First, we'll start with the simple view, how we all see a lease from the driver's seat. Then, we'll peek behind the scenes at the hidden business of it all. After that, we're going to follow the very surprising path that sales tax takes. And finally, we'll put it all together to get a clear verdict, lease versus loan. All right, let's start on familiar ground. Section 1, the simple view. This is the lease that we, as drivers, know and interact with. I mean, at its heart, the whole experience feels just like a long-term rental, doesn't it? You're basically paying for the convenience and the fun of using a brand new car for a couple of years, but you don't have that long-term commitment of actually owning it. It's clean, it's simple, it's predictable. And that's exactly what makes it so appealing. You're not buying the whole car. You're just paying for the part of it that you use up. It's depreciation. And that's the secret to why the payments are lower. Then at the end, your options are crystal clear. You can just hand back the keys and walk away, buy the car if you've fallen in love with it, or, hey, just roll right into a new lease on another new car. All the rules about mileage and condition, they're all spelled out right from the get-go. But here's the twist. While we're all focused on our monthly payment and our mileage allowance, is the company on the other side of that contract, the captive finance company, which is usually just the car maker's own bank. Are they seeing it the same way? Is it just a simple rental to them? Oh, the answer is a huge, definitive no. This right here is the absolute core of our entire explainer. There are two completely separate worlds operating at the exact same time. For you, it's a rental. For them, it's a high-stakes asset management business. And once you understand their world, it changes everything. And that brings us right to Section 2, the hidden business. Now we're going to flip the script and look at the lease from the finance company's point of view. Okay, so the very first thing you have to wrap your head around is that a lease is not a loan. In the world of accounting, it's what they call an operating lease. And what that really means is the finance company is in the business of owning and managing a massive multi-billion-dollar fleet of depreciating assets, which happen to be your cars. So what does this actually look like on their books? Well, that car sitting in your driveway is a fixed asset on their balance sheet, just like a factory or a piece of heavy machinery. And your monthly payments, they don't see that as interest. They see it as rental income. So their entire job, their whole business, is to manage the declining value, the depreciation of that asset over the life of your lease. And that brings us to the single most important term in the entire leasing universe, residual value. This is the magic number. It's the company's best guess, their forecast, of what your car will be worth in 2, 3, or 4 years. And this number, which is locked into your contract from day one, is what determines how big your monthly payment is, and it represents the company's biggest gamble. Because if they get that forecast wrong, if the used car market suddenly tanks and your car is worth thousands less than they predicted, they are the ones who take that loss. Their whole business model depends on predicting the future, and that's why their biggest financial risk isn't you missing a payment, it's the value of the car itself. Okay, now for what might be the most fascinating and definitely the least understood part of this whole thing. Get ready for Section 3, the surprising tax journey. Let's actually follow the money and see where the sales tax really goes. It's kind of like a 3-act play. First, the finance company buys the car from the dealer. They pay sales tax on it, but because it's a business buying from another business, they immediately claim a full tax credit and get all of that money back. For them, it's a complete wash, tax neutral. Step 2, you pay sales tax on every single one of your monthly payments. The finance company just collects that money and passes it straight to the government. And finally, step 3, when your lease is over and they sell the car to a used car dealer or to you, the new buyer pays sales tax on that sale too. This table lays it all out beautifully. You can see the flow so clearly. The finance company pays the tax, but then immediately gets it back. Then the consumer, that's you, pays tax on all the payments with no way to get it back.
And finally, the next buyer pays tax on the used car. You see the pattern? The businesses are just channels for the tax money to flow through. So the bottom line is this: the government gets its tax money from the people actually using the car. It collects a little bit of tax from you every month for the entire lease, and then it collects a big chunk of tax all at once when that car is sold into the used market. So now that we've seen both worlds and we've followed the money trail, let's bring it all together for our final verdict. Section 4. Lease versus loan, the final showdown. This chart is basically the cheat sheet for everything. With a lease, the finance company owns the car. They earn rental income, and their biggest worry is the car's future value, and the tax is paid a little bit every month. With a loan, you own the car, the company earns interest income, and their main risk is whether you can pay them back. And you pay all the sales tax right at the very beginning. They are two totally different financial animals, designed for completely different jobs. If you take away only one thing today, let it be this. A lease is a really sophisticated financial tool built to manage the depreciation of an asset over its entire life. A loan is much, much simpler. It's all about managing the risk that a borrower won't pay back their debt. And that really brings us to the ultimate insight here. You, the consumer, you see a simple, affordable way to drive a new car. The company sees a complex, risky portfolio of assets that they have to manage. The real expertise, the real aha moment, comes when you can hold both of those views in your head at the very same time. So the next time you see a car ad with a ridiculously low lease payment, you'll know exactly what's going on behind the scenes. You'll understand the gamble the company is taking on that residual value. And so the real question is, now that you can see both of these worlds at once, how does that change the way you think about getting your next car?